the time being, we're putting the spotlight on the quick commerce space. A lot of platform companies, and we have so many of them that have come to the listed markets now. Elara has done an interesting note. They've done an interesting research comparing how Indian platform companies are moving towards, early to mid-cycle, and what the global precedent tells us. Large companies like US giants like Amazon, or even Chinese companies for that matter, they are, of course, early movers in the platform and quick commerce space. Karan Taurani is with us, who's worked behind that note. Karan, what are your findings?
Hi, Silvi. Good morning. So two things to note here. One is that, India is going to see an inflection point here in terms of e-commerce penetration. What happened in China was the e-commerce penetration moved up from 11% to 30% in about 8 to 10 years time frame. Similar was the fate of US as well, wherein the penetration doubled up in about 7 to 8 years. We believe India is also poised for this kind of an inflection over the next 7 to 8 years. We will see e-commerce penetration moving from 7% to 14%. The drivers for this are obviously the demographic factors, which is logistics, payment mechanisms, and increased per capita income. But the big delta is going to come from two things, specifically a market like India, which is going to be different as compared to global counterparts. One is the quick commerce penetration, which is going to amplify the growth rate in the e-commerce side. And second is categories. So many of the categories, if you look at the fashion category, if you look at the categories like general merchandise or even food for that matter, the penetration numbers are extremely low as compared to global markets. So because of these two factors, you will see India market also going to double e-commerce penetration number over the next 7 to 8 years.
Karan, hi, morning. You also say that the global precedent shows that internet companies reach profitability only after about 15 years. You're giving examples of Amazon, Alibaba, DoorDash, etc. So what are the implications of that here in India for stocks under your coverage?
So if you look at any of the companies, we've kind of put these companies into various life cycles. The overall time frame is about 30 years. Most of the internet companies in India, which are B2C led, are at mid of this cycle, which is 18 to 20 years kind of time frame. And if you look at growth rates for most of these companies, it was in the range of 40 to 50% until about 5 to 7 years back, which is now converged more towards 20-25% for a mature e-commerce company, or rather for a food tech as a segment. But QC is a new business model, so that is just going to scale up now, and that will see continued growth rate over the next 4 to 5 years as well. But the point we're trying to make here is that after 18 to 20 years of operations, you see a big shift in terms of profitability. Okay, and I think we saw that in the case of food tech as well. I think most of the food tech companies are now operating at healthy EBITDA margins, and growth rates have kind of converged over there. QC, I think it's a long haul, but I think food tech is kind of on the maturity stage right now. But a lot of it will depend in terms of how the market dynamics also pan out. So if you look at the Chinese and the American markets therein, Amazon is a leader with more than 50% market share. In the China market, you have JD.com and Alibaba dominating the space there. India market is slightly fragmented. So now we're seeing e-commerce players coming into QCom. So another 3 to 5 years of consolidation may happen. Post that, you'll see a big focus in terms of profit in the QCom as well, just as we saw in the food tech segment.
Just a quick word, Karan. So that's a critical difference, isn't it? QCom, like what exists here, does not exist anywhere else in the world. I mean, maybe China, specific markets, etc. But some of the larger companies. So is that a critical difference? So can we extrapolate this at the stage at which profitability kicks in? What happened outside of India to India? Because QC is the big driver here.
Yes, absolutely. So I think the way e-commerce or food tech took 15 years to get to profitability, QC may not see that much amount of time, because e-commerce is already a category which is being created. You need to create the category. You don't have to actually get new customers for QC. It is just use the existing e-com customers and give them this as a value-add service. So QC will actually take a lesser time to attain profitability. And we've seen that in the metro markets as well. A lot of commentaries indicating that mature stores are at about 3 to 4% EBITDA as a percentage of GOV. So there is steady traction here, and QC could see better profitability versus e-com and food tech from a time perspective.
So that's good to know, Karan. However, the dilemma for shareholders and investors here is you don't have pure play. I can't buy only quick commerce right now, or not buy food delivery, or only buy the out-of-home business. The listed companies are rolling all of this and more into one listed umbrella, right? So from an investor perspective, and we've seen the market reaction, and they're going on investing in some of these newer businesses, and every time they announce more capex and there's a burn and, the profitability comes under pressure, the stocks fall. So from a listed stock perspective, what should be done? And how much of it is already, this growth that you're talking about, how much is already currently discounted? And how should investors play the listed companies?
So exactly for that, we've derived two ways to value these internet companies, because there's always a dilemma whether one should value this on profitability, free cash flow, or one should value this on growth. So the ideal way is that for the first 15 years or say 18 years of operation, one should look at growth over here, because profitability will not come. That's quite obvious, because given the kind of market dynamics we are in, it's highly competitive. You see price war, you see new players coming in. After 18 to 20th year, once you see the category being penetrated, once you see acceptance of this by the consumers, the shift happens towards profitability. So we've done two valuation methods here. One is in terms of EV sales. We've actually benchmarked this to Amazon US. And usually when you benchmark EV sales multiple, you don't assign the time frame here. So we've actually benchmarked EV sales multiple to exact time frame in terms of where Amazon was around 18 to 20th year of operation. Growth rates were about 20 to 23% for them at that time. Their EV sales multiple was around 2.5 times. And assuming today's returns growth rates in the next 3 to 4 years, CAGR basis about 45 times for the console business, 45% rather, you could see a 4.5 to 5 times EV sales multiples. That's the first valuation methodology that we have seen here. Second is we also done a DCF here for a long-term perspective, that let's say how much can this category penetrate? What is the kind of profitability numbers this business can throw? From the food side, it's very clear that in terms of penetration, we are extremely low as compared to global counterparts.
Right.
Our food penetration is only 1.4% of population. Globally, it's about 5.5%. It was 0.7% until about 5 to 6 years back. So basis that, you will see a convergence in the food growth rates from about 18-20% today to 14% 5 years hence. And then by FY35, it will move to about 8 to 10%, which is like a legacy business, similar to what QSR companies are going today largely.
Sure.
Then coming to the QC side, we've again taken the cash flow here. We've taken the penetration numbers here. For QC, we do expect profitability to come in the next 5 to 7 years, but QC will have a higher penetration number because of a larger use case, a larger AOV, and a larger TAM as compared to food tech.
The last point that you said, so you say companies here already traded some 70% EV sales premium to global companies. So the question, if I flip it, is what can cause a derating?
So I think growth is a big variable here. So I think it's not only just profitability. Obviously, part of profitability is very important to drive valuations from here on. But growth is also an important metric. Let's say if the eternal growth rates converges from maybe 45% console basis today to 30%, you could see valuation derating basis that as well. So apart from profitability, growth is also important, that you do have 25-30% growth rate, not from existing businesses, but you also drive into new markets, new businesses to drive better growth, to support your premium valuations.
And QC maturity, quick commerce part of the business, that'll take 5 to 7 years to mature, right? So that much volatility investors need to be prepared for. All right.
Absolutely.
Okay. All right, Karan, very helpful and very exhaustive report. Thanks so much for running us through some of the highlights over there. That's Elara on food tech, quick commerce, and more, all the platform companies.